So why do banks decline mortgage applications? Sometimes the biggest frustration isn't actually to do with being declined, but not knowing what you need to adjust to make a positive outcome. That is the biggest frustration for most clients. What's going on, everybody? It's Blandon here from Mortgage HQ, and in this video I want to share with you guys 3 common mistakes mortgage applicants make and how you can avoid those. First one is going to be around non-disclosure. Second one is going to be around income that is outside of the ordinary policy. And third is to do with the property that you're buying and the security itself. So the first one, non-disclosure. Believe it or not, if you put together an application for the bank, you need to disclose as much as possible about your financial position. And there are 4 key areas that you need to look at. The first one is your asset, and then second, liability, third, income, and lastly, your expenses. Although it sounds pretty simple, non-disclosure is actually one of the biggest reasons why applications get delayed or declined. And on the rare occasion, we've even seen approvals get taken away by the banks because the client failed to tell them they were pregnant at the time of application and they actually went on maternity leave when the settlement happened and they took away that approval. So to minimize non-disclosure mistakes, here are a couple of tips. The first is just to invest a bit more time up front so you can get the information right. 2 areas that you need to take extra care for are liabilities. All of your finances, mortgages, credit cards, all those things will contribute towards your application and how much you're going to get approved. So it's important to get the limits, the interest rates, and the terms right and get that information across into the bank. Second are your expenses. Anything that is a regular outgoing should be disclosed. Insurance, childcare expenses, subscriptions, donations and tithings, and even your investments and savings that are set on a monthly, weekly basis. These will all affect your borrowing capacity, and if you don't disclose them in the beginning and the bank picks them up as an expense later, it's going to reduce your borrowing capacity. So to avoid surprises, you're best to just make sure those are correct. And if any of them are actually going to discontinue when you take on the new mortgage, you should also tell the bank because that's going to increase your borrowing capacity. Another tip is just to be transparent with the future changes about your financial position with your mortgage advisor. Things like having a baby, changing of jobs, or changing of hours. The more your advisor knows, the better they can make a judgment call on how to present your application. Because if you presented that information to your mortgage advisor and they don't disclose it to the bank, that's their fault, not yours. Now, the second major reason that applicants actually get rejected is because of income that are outside of the ordinary bank policy. The easiest way to understand this is that income that are fluctuating, going up and down, and are not consistent. Commission, bonuses, and overtime are all viewed slightly differently across all the banks. For example, a bank might take commission for 6 months, but they'll only apply 80% of their commission towards your servicing capacity. Whereas another bank might look at 2-year average and they'll use 100% of that income. Business income usually has the biggest discrepancy because the standard bank policy will want to use the average of 2-year financials. But there are some instances where the bank will just use 1 year of financials, and sometimes they will even consider using the forecast income. Now, a tip to reduce the chance of getting a decline here is understanding which bank might be best suited for your income position. Some banks are going to look at those income more favorably, and you'll be able to use more of that income towards your borrowing capacity. A question you could ask the bank is, how would you view my income if I'm on commission, and how much of that would you actually use in the servicing calculation? Of course, this becomes a lot easier if you just use a mortgage advisor because they'll have all the banking policy guides and they'll be able to just search a PDF to find out exactly what's going on with the different banks. Now, the third most common reason why people get declined is because they forget to smash the like button for the YouTube algorithm. And I guarantee you, if you smash that like button right now, you are going to increase your approval rate by at least 10%. Alright, back to our third point. Banks might reject an application due to the property that you're buying. They want properties that are easily sold in the market and something that would sell really quickly. In case there's a mortgagee sale, they want to be in a position where they can recuperate their money easily. And there are 3 types of properties that are more likely to be declined. First is plaster home with high moisture reading. Second are homes with unconsented work. Us Kiwis have this DIY mindset and a can-do attitude, but sometimes not doing it the long way, getting the consent and getting that work done properly, it's gonna stop us from selling those properties really quickly because not all banks are willing to finance that. The third type of houses are really old ones that are not in a livable state. There are several reasons why they're less desirable to the bank. Firstly is to do with liquidity because again, it's not going to sell as quickly as a nice renovated house because there's a lot more first home buyers. Second, clients tend to settle these deals on a minimal deposit, so they might not have enough money on hand to actually restore that property. And third, they just worry about structural issues. So a tip to reduce the chance of getting a decline here is to get relevant reports up front and present it to the bank. Things like a builder's report, a moisture reading report, a builder's recommendation on exactly what needs to be fixed and how much it's going to cost. This is going to give the bank a lot more confidence and exactly how much you might need to still fork out to get the property to a good state. Registered valuations are very helpful as well, especially ones with a value of the property as it is without renovations and one as if complete if the renovations were completed. And when in doubt, just talk to a mortgage advisor because they'll be able to guide you on what reports you may need before you spend the money, and they'll be able to guide you on which bank is going to have better appetite for the type of security or property that you're actually buying. So there you have it, folks, the 3 most common reasons why bank applications get declined. Did I miss anything? I'd love to hear from you. Leave a comment down below, and if you learned anything, you can support us by smashing the like button for the YouTube algorithm. And I will see you guys in the next video.
My favorite thing about the workshop is how simple it is. So language is really easy to understand, so anyone with no property knowledge can understand what's going on.